Hey, Stephen, thanks so much for your question and certainly your feedback on the podcast. I don't listen to podcasts on Spotify, so I didn't realize they don't have like a like or thumbs up button. Hopefully, they sort of introduce that. Anyway, you've got two parts to your question. The first one is my opinion on the geared ETF products that are available on the ASX. And then I think the second question is really around having a diversified geared fund. So as you've correctly identified, there's a couple of geared products. The ones with higher gearing tend to be, or actually are, only specific geographical markets. So obviously the Australian stock market and the US stock market, S&P 500. You've got to realise that, well, you might have already realised that the level of gearing has to be low enough that the dividend income pays for at least most or all of the interest cost. So unlike property, you're never going to get any negative gearing from these products, which is fine. But when you see more diversified geared ETFs, you'll see that they've got a lower rate of gearing. And one of the reasons for that is because if we're going to invest in different sub-asset classes like emerging markets, for example, we're not going to get a lot of income, as in dividend income and so forth. And therefore, we can't afford to borrow at as higher levels. I just wrote a blog about gearing inside super and the benefits of that. If you've got a self-managed super fund, you've obviously got lots of flexibility in terms of which ETFs you invest in and which ETFs you choose. I think all the geared products are good. They do their thing. I would be really careful about investing in geared products when markets are at all-time highs. So I have personally invested in GGUS and GEAR, which is the Australian version. So I've used those products. I mean, they've been around for a few years. So, for example, I invested in GGUS and GEAR when in 2020 when the market dropped. And so I think the way that I would use those geared products is, and we do use them for some clients, not all, but some clients we've used them. The way I would use those geared products is I would be selective about my timing. Now, if you look at the long-term data, timing doesn't make a difference. You know, if you use the geared products, say GGUS today when the S&P is at all-time highs, when you look at the valuation ratios that don't make any sense. So you would say, okay, US market is an index, overcooked. Most likely that the future returns will be less than the long-term average in terms of future next 5 or 10 years. Despite that, you know, if you still put a whole bunch of money in there and hung on to it for 30 years, you'll be fine. But I don't like to take that approach. I like to obviously apply some sort of common sense to it. So the way that I would use those geared products is I'd be very selective, particularly if they've got higher gearing levels like 50, 55% or something like that. I would wait for a market correction, a significant market correction, and then I would use those products. So I have reduced my exposure to GGUS. I sold that down a few months ago when I became concerned about where the US market is. I mean, if you look at the timing of that sale, I've missed out on a bit of profit there, but not huge. There's that saying, I made money because I didn't wait until the peak to sell my stocks. So, it's not about squeezing every single bit of profit out of there. I still hold GEAR, which is the Australian exposure. I've got quite a bit of that, and my intention is to probably hold on to it for many decades. So I won't sell that down. That's the bit that I bought during just in 2020 when the market, I think March, April, when the market corrected. So I think those gear products are good. You want to be careful about how you use them. If you're putting a whole heap of money in there, well, maybe get the timing right. If you're progressively investing, that's probably okay. Keep doing that. You also got to be conscious that they don't give you, they give you diversification in a geographical market, but they are very single sensitive in a geographical market. The second part of your question is you asked, will we see some geared products that give you exposure to, the broad international indexes? And you've mentioned VTS and also VEU, both Vanguard ETFs that give you exposure. I like VEU, by the way, just because it's ex-US, gives us some exposure to emerging markets, which are really cheap at the moment, and Europe and the UK. Japan's obviously going through a little bit of a correction, and there's about 9% of exposure to Japan in VU, so that's the only concern with that one. But I do like that ETF. You may not, or you may not know, but BetaShares released a kind of very diversified geared ETF. The ticker code is GHF. It's got a relatively low level of gearing, again, because of its diversified nature. It's probably not going to generate a whole heap of dividend income to pay for the interest cost. I think the geared rate is about 30-35%. Look, that's enough. You don't necessarily need to gear to 100%, of course. Some gearing is good. I think you need to find a balance between what is my exposure? So where are my monies invested? How diversified in terms of broadly across geographical markets is it invested? And then also the gearing rate. You probably want to achieve or optimize both those factors. And I think GHHF does that. So if I had a self-managed super fund and I wanted some geared exposure, I think I would go GHHF. I might use some gear, so some Australian exposure, just because of the slightly higher gearing rate, and you're going to get a little bit more dividend income. And also, we're in Australia, we want to fund retirement off Aussie dollars. So to some degree, having sort of investing in the Australian economy where we're going to actually fund retirement, I think makes a lot of sense. So you sort of want a little bit more Australian exposure. But if you went all in GHHF, I don't necessarily think that's would be a terrible long-term decision. So you mentioned you've got at least 20 years to retirement. I think that product will perform really well over the next 20 years. A bit of a long-winded answer to your question, but it's a really good one. Tomorrow I have, so that's the 26th of June, I have a blog coming out that talks about being all growth in super, and then also I touch on gearing inside super as well. So that might be of interest as well. I might ask the team to drop in a link to that blog just in the comments underneath this video for anyone else that might be watching. Anyway, they're my thoughts on geared ETFs. Of course, none of this is personal advice, but just general comments. Cheers.